This is the Retirement Lifestyle Advocates radio program. I'm your host, Dennis Tubbergen. Glad you decided to listen in today and hope you had a great holiday weekend. If you haven't yet taken advantage of all the free resources that exist on our website at retirementlifestyleadvocates.com, I'd encourage you to do that. There, by creating a free login, you can get access to my weekly newsletter titled Portfolio Watch. You can also get access to the podcast version of this radio program. And you also get access to my weekly Headline Roundup newscast. You can participate every Monday noon live, or if you don't have the opportunity to do that, we record that and post it on the website. So all you need to do is go to retirementlifestyleadvocates.com, log in, get your free login, and you'll get access to all those free resources. Now, I get asked all the time about what do I think stocks are going to do? In fact, on a weekly basis, I speak to a radio show listener or a book reader who's inquiring about our services for clients. And as you all know, if you've been a long-time listener, we are primarily all about education. Well, these conversations typically evolve into me asking them some questions about their financial goals, often, in particular, specifically their retirement goals. What planning have they completed? What do they need as far as retirement income? Do they aspire to a retirement? And after learning a bit about their finances, I ask them a simple question. And this simple question that I ask them, surprisingly, often stumps them. So let me ask you that same question today. Do you have any idea how your current investments performed during the last market decline? Now, just because something happened in the past doesn't mean it will happen again in the future. As our industry likes to talk about, past performance does not guarantee future results. However, it gives you an idea anyway from an historical perspective what your current investments may have done in a market downturn. And I happen to believe it's an extremely important question, and one that anyone who aspires to retirement, who's accumulating a nest egg, should know the answer to. Now, the closer you get to retirement, the more important knowing the answer to that question is, particularly if you're going to need to use investment assets during retirement to supplement retirement income. Now, if you have been a long-term listener to RLA Radio, you're undoubtedly familiar with the term drawdown. Simply defined, drawdown is the percentage decline from the peak price of an investment to the low price of an investment. What were the prices at the peak? What were the prices when this particular market stopped going up? And what were the prices at the trough, at the bottom, when prices quit declining? During the financial crisis and the stock market decline of 2007 to 2009, it took 20 months for the market to bottom. The peak occurred in July of 2007. The bottom or the trough occurred in March of 2009. And the drawdown over that period of time was more than 50%. So an aspiring retiree with $500,000 invested in stocks may have seen her investment account fall to a low of $250,000 or even less before the market bottom was in and investments began to recover. Now, here's why drawdown is such an important statistic. In fact, I would argue that this statistic is more important than average annual return, which is the statistic that's often touted by many in the financial industry. Let me ask you a question as it relates to average annual return, just to prove my point. If you had an opportunity to get an investment that gave you a 0% net return or a 25% average annual return, which would you prefer? Now, I told you it's a quick question, but if you're honest, you say, hey, a 25% average annual return sounds pretty good. I would take that. What if your investment portfolio had $100,000 in it, and at the end of 1 year, you experienced a 50% decline? You would now have $50,000 in that account. Now let's assume in the next year you experience a 100% gain. You now have your $50,000 account growing back to $100,000. In the third year, perhaps another 50% decline. In the fourth year, perhaps another 100% gain. Over those 4 years, you have an average annual return of 25%. If you take 100 plus 100 minus 50 divided by 4, you get an average annual return of 25%. However, you've got a 0% net return. Here's what's important when it comes to returns. It is sequence of returns. It is the order in which you experience the returns because of this drawdown factor. See, when you talk about drawdown, it's impossible to have the conversation without talking about something called the break-even curve. See, if your account declines 50%, it requires a 100% gain to get back to even. If your account declines 10%, it requires an 11.1% gain to get back to even. And if your account declines 90%, it takes a 900% gain to get back to even. Now that brings me to where stocks are presently. That brings me to the point that I want to begin to answer the question that we asked at the beginning of this segment. See, given the current valuation of stocks, I find it remarkable, and I should add, not remarkable in a good way, that many retirement account investors have a substantial amount of their portfolio invested in stocks. They're adhering to this long-held belief that a 60-40 portfolio is the way to manage retirement assets. And if you're not familiar with the 60-40 portfolio, it simply advises that 60% of the assets be invested in stocks and 40% of the assets be invested in bonds. This portfolio mix, this allocation mix, is recommended by a lot of Wall Street advisor types, and in my view, it will fail many who use it in the months ahead. Why? Because stocks remain extremely overvalued from my research. And I don't think that interest rates are likely done going higher. So as interest rates go higher, bonds go lower, and if the stock market goes lower, then any stock-related investment also likely goes lower. Now, let me add that I am not alone in holding this opinion that stocks are overvalued. Many of you probably caught last week's show on which I interviewed Dr. Robert McHugh. On this week's program, coming up in the next segment, I'll be interviewing Murray Gunn. Murray is a lead analyst for Elliott Wave International, and I'm going to ask Murray what his view of stock valuations are. But Dr. McHugh wrote a very interesting analysis piece. It's short, it's to the point, and it's extremely profound. He said if you study periods of time when the market was dominated by a few large corporations, like it is now, there's a pretty good correlation that these periods lead to economic recessions and deep stock market declines. Right now, the top 10 market cap stocks are dominating the stock market at the highest 85% level seen in the history of the stock market. This is not a bullish condition, Dr. McHugh adds. It is actually just the opposite. And if you go to his website, which is Technical Indicator Index, you can find this article in the free article section. Several of the economic recessions that we have seen, several of the stock market plunges we have seen over the past 40 years have arrived at periods of time when a few mega cap corporations were at an elevated concentration of the entire stock market. This time, it's the artificial intelligence perceived companies like NVIDIA, Microsoft, and Apple that are dominating the market. In fact, these three stocks have almost 20% of the market cap of the entire stock market. So the bottom line is this, and I'll talk more about this in the fourth segment of today's program. There is simply not a lot of participation in the latest stock market rally. It's the narrowest rally, in fact, since the early 1970s, which preceded the stock bear market of 73 and 74. Again, I'll talk more about this in the fourth segment of today's program, but stay tuned. On the other side of this break, I'll be interviewing Mr. Murray Gunn, lead analyst at Elliott Wave International, and I'll get his take on where stocks go as well. Stay with us. Welcome back to RLA Radio. My name is Dennis Tubbergen, your host. Joining me on today's program is returning guest, Mr. Murray Gunn. Murray is a lead researcher for Elliott Wave International. You can learn more about Elliott Wave International at elliottwave.com. Whenever Murray's on the program, I always get terrific feedback. And Murray, thank you for joining us again today, and welcome back.
Well, thank you for having me on again, Dennis. It's great to be here.
So, Murray, just for our listeners that may not be familiar with Elliott Wave, it's been about 6 months since you've been on the program. Maybe just a quick overview of your work and just a description, if you could, please.
Sure. Well, the Elliott Wave principle is what we call a fractal-based model of the economy, and it was discovered by a man called Ralph Elliott in the 1930s. And he discovered that human herding behavior causes markets like the stock market, which is a leading indicator of the economy, to exhibit certain identifiable and repeatable patterns. And what Elliott noticed was that these patterns repeat at every time scale. And so it really enables cycles of herding behavior to be anticipated from the short term to the very long term. So what specifically he did, because he lost a bit of money in the 1929 crash, and took the data from the stock market and made an empirical study of what was actually happening. And he discovered that these patterns could be labeled and identified, and crucially, it introduced a forecasting element to market analysis that was previously not really appreciated. So, for instance, if there's a triangular pattern present on the chart of a stock market, it's a fairly reliable indicator of what's going to happen next when the pattern is complete. So, it was a big discovery in market analysis, and as I say, introduced this forecasting aspect, which was underappreciated at the time.
So, Murray, given that you said stocks are a leading indicator, and taking a look at what stocks have done, really the conclusion that you reach would maybe depend a lot upon the time frame. If you go back to the end of 2021 to the present, stocks are up slightly. If you look at the last 6 months, stocks are up, at a level that is, 30 to 40%, depending upon the index. What's your view of stocks presently, and then what does that tell you about the economy?
Well, it's really interesting because obviously there are many indices that we can look at in the world, but if you look at the world stock market index, specifically the ticker is VT, which is the ETF that we look at for this. It's hovering around the highs, just above the highs, like you mentioned, reached in 2021. And our thesis, using Elliott Wave analysis, is that the rally since 2022, the low that was done then, is the second wave of a three-wave correction from that 2021 high. Specifically, it's what we would call in Elliott Wave terms an expanded flat pattern. So the market makes a move down, it then corrects that move to make a marginal new high, but it's still part of the corrective process. And so what we call wave C should be coming next. That's the third wave down, and that should be a decline to below those 2022 lows. So specifically with the World Stock Market Index, we're talking, 30% down, at least. And there's lots of indicators around to say that we are reaching that sort of top in the stock market.
So, Murray, the analysts that were jumping up and down and celebrating when the market made new highs, suggesting that the bull market is back, you'd have a differing opinion.
For sure. One of the things, if this rally from the 2022 low has been what we call a B wave rally in an ABC correction, then one of the ways we can identify that is by what we call market breadth. And what you tend to find is when in a B wave rally in an expanded flat. Sorry, I'm getting a bit technical here, but when the market makes a new high, and like you suggest, everyone jumps around. If you actually look into the internals of what's happening there, it's not a healthy new high, because the breadth of the market, and not just the S&P, which is famously really only the Mag 7, and Nvidia represents a third of the S&P's gains year to date, I think, but it's all over some of the Western markets. This narrow breadth, that's a sign where only a few stocks are fueling the rally, and our sectors are fueling the rally, specifically just technology, big tech. It's a sign that the market overall isn't healthy, and that is tied up as well with another classic indicator that we look at, and this goes back to Dow theory, Charles Dow, of which Elliott was a big fan, and actually introduced the sort of forecasting element to Dow theory that it lacked, at the time. But one of the most important aspects about Dow theory is looking at what we call confirmation. So if it's a healthy bull market, the industrial average and the transportation average should both be making new highs together. But that's not been the case. In fact, there's been a year-long divergence where the Dow Industrials have been making new highs and the transportation average has not. And interesting, the last time that such a long divergence took place was from about 2018 into the end of 2019, start 2020, just before the big crash there. But there's lots of other indicators to suggest that we are at an extreme of bullishness. We've got, if you look at volatility, for instance, Dennis, the VIX is obviously relatively low, but if you look at the ratio of the S&P to the VIX, it's at all-time highs, meaning there's all-time complacency in the market. Another indicator to suggest extreme complacency is looking at the ratio of consumer discretionary sector to the consumer staples sector. That's towards its all-time highs as well. So there's lots of indicators. Look at cash as well. The cash as a percentage of assets in equity mutual funds is at an all-time low, and I don't want to hit everyone with statistics, but the percentage of U.S. households' wealth invested in equities is at an all-time high, near, I think, 35%, and that's above where it was in the end of the 1990s before the dot-com bubble burst.
So, Murray, what do your charts, what does your Elliott wave analysis tell you about U.S. Treasuries? We've seen a really rough few years in U.S. Treasuries as the Fed has been increasing interest rates. Even with no action, the yield on the 10-year U.S. Treasury has risen from the end of last year. Certainly, the U.S. is not the greatest credit risk. It's becoming its credit is rating should be deteriorating by the day. What does your analysis tell you about where U.S. Treasuries go from here?
Well, what's really good about Elliott wave analysis is it can give you an edge and give you that forecasting element, um, particularly when you look at the structure of patterns coming off all-time highs or lows. So obviously bond yields were at all-time lows, decade lows, near 0%, roughly, with the 10-year. And since then, since 2020, we've had that what we call an impulsive rise. And when we say an impulsive rise in yield, we mean that it's occurred in a five-wave pattern. And so once we see a five-wave pattern occurring off an all-time low, we can be pretty confident that there's going to be a three-wave correction, an ABC correction, which we think that's the stage that we're in at the moment. So we're correcting lower in yield from the previous highs, probably coming into wave C of that correction lower in yield now. But the most important aspect is that once this temporary move lower in yield is over, then according to Elliott wave analysis, we should see another extreme movement higher in yield. And when you think about it, you alluded to it there, that could be consistent with what's going on. Obviously there's an increasing focus on the national debts in the US. I mean, it's what, $35 trillion now in public debt. I think $1 trillion per annum is being spent on interest payments alone.
Mm-hmm.
And that's higher than the defense budget now. And, people have done some studies looking at history. And when that happens, when countries start spending more on interest payments than on defense, it's not a good sign for the creditworthiness of the country. As you say, I mean, the US is immune really from this at the moment. If the US didn't have the world's reserve currency, then the US Treasury market would not be nearly as popular. And we can see that coming through in what we call the credit default swap market. Sorry to get too technical again, but basically this is a market which allows investors to hedge against the risk of a country defaulting on its debt. And if you look at the relative CDS, credit default swap of America, it's really showing some deterioration in confidence in the US Treasury market.
Well, my guest today is Mr. Murray Gunn. He is a lead analyst at Elliott Wave International. You can learn more about their work at elliottwave.com. I'll continue my conversation with Murray when RLA Radio returns. Stay with us. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. I'm chatting today with Mr. Murray Gunn, a lead analyst at Elliott Wave International. The website to learn more about Elliott Wave is elliottwave.com. Another area of, I won't say specialty, because I believe Murray, Elliott Wave and Bob Prechter and you invented the science of socionomics. We're going to talk about that in this segment. If you'd like to learn more about the science, you can go to socionomics.net. And Murray, for our uninitiated listeners, can you define the science of socionomics?
Sure, Dennis. Well, Robert Prechter's socioeconomic theory stems from evidence that it's the trend in social mood that determines social actions, not the other way around, as most people think. So most people would think that if something negative happens, then the mood of society then turns negative. But socioeconomic studies that Robert Prechter has done over many decades, and the Socioeconomic Institute has taken that up as well, suggest that the negative mood trend comes first before the negative action. And of course, vice versa for positive action. So, for example, conventional thought would be that recessions cause business people to be cautious, whereas the socioeconomic thinking would be, or logic would be, that it's cautious business people who cause recessions. So because the social mood is the driver of everything, it tends to show up first in the stock market. And so trends in the stock market, if we look at trends in the stock market, we can anticipate social actions. And also social actions can help us anticipate where we are in the stock market cycle. So, a way to think about it is in terms of, causality as well. So, another conventional thought would be that looking at the world would be to say that war makes people angry, whereas the socioeconomic thinking would be that angry people make war. And, what tends to happen at extreme lows in markets is you tend to get conflict. At extreme highs in markets driven by positive mood. On the other hand, you tend to get more reconciliation. So socioeconomics can really help us determine where we are in the markets, and by looking at the markets, we can anticipate social actions.
So, Murray, we were chatting a bit before we started actually recording this segment. And there's a lot of interesting politics going on now in Europe with the elections in France, some upcoming elections in the UK. Talk a little bit about socioeconomics, and let's do so in context of what you see going on in politics.
Well, if you look at what's happened this century, it's been really interesting. It's really over the last 20 odd years, there's really just been one market in the world that's been keeping the global economy up, and that's been the US market. I mean, Japan topped out in 1989. It's just made a new high after 34 years of a bear market there. China topped out in '07 and has been going sideways to down, and most European stock markets have gone sideways since the turn of the century. So what this has resulted in is a severe underperformance of the European stock markets, and that's been driven by this aspect of negative social mood. And so by looking at this, it was kind of, using socioeconomics thinking, this trend towards far right politics in Europe, it was quite forecastable. And so what we've had now, of course, it's not just the Eastern European countries, but we've now got far right politicians in charge in Italy. It looks like, judging by the French elections that are going on at the moment, it looks like obviously the far right in France, they're going to be a significant player there. And you mentioned the UK election, which is coming just in a couple of days' time here. So maybe the results will be out by the time your listeners listen to this. But what's really interesting is it looks like the incumbent Conservative party are going to be, according to the polls at least, they're going to be decimated. Perhaps as badly as the Canadian Conservatives were in 1993, when I think they went from 156 seats down to 2 in Canada. And so, again, it's the negative social mood has resulted in these shifts, in these big shifts in politics that we're seeing. So the Conservative Party here in the UK is probably going to be replaced by Labour, because we have a first past the post voting system. But the other big story that your listeners might be interested in from a socioeconomic point of view is that even in the UK, there is a big shift to far right politics, because there's a small party called Reform. They've been growing quickly, and it looks like they're going to take a lot of votes away from the Conservatives. So the shift towards far right politics in Europe has come about because of a negative social mood, which has been obvious for a couple of decades at least with this underperformance of the stock market.
So Murray, when you look at what's going on around the world, no shortage of geopolitical tensions. What does socionomics tell you about how some of this may play out, if that's a fair question?
Well, I mean, there's a couple of aspects there. Certainly, with the like I mentioned, the only market in the world holding the global market up has really been the US. So with this malaise that we've seen over the last certainly the last 15 years since the great financial crisis, what we can see obviously is happening is a movement away from the trend of globalization. And we're going much more against that, much more to isolationist geopolitics, and that's a negative social mood trend. When there's a positive social mood trend, people come together, and you have that trend towards globalization. When there's a negative social mood trend driving the world, you get the opposite effect, and that's what's happening just now. But specifically looking at China, what's really interesting about China is, like I mentioned, the stock market topped out in 2007, looking at the Shanghai Composite Index, and since then we've seen a very clear Elliott wave pattern, which we call a triangle, which is a bear market, basically a sideways market. And of course, China, as your listeners will know, has been suffering economically the last number of years, and that's been a result of this negative social mood trend. But what's really interesting now is that pattern looks like it's reaching its extreme, which means two things. It means that one, looking forward 5 years or so, then China is probably going to be back into a positive social mood trend because it's reaching the end of its negative trend at the moment. But what that also means is that as this negative trend reaches its extreme, which is now, the risk of negative social actions from Japan is quite high. So, obviously there's a lot of focus on Taiwan, what might happen there. So, we're watching that very carefully.
So Murray, a lot of the listeners to the RLA radio program reside in the United States. While we're on the topic of politics, do socionomics give you any insights as to what may play out here in the U.S. this year politically, since this is an election year?
Well, it's interesting. The Socionomics Institute did a study a number of years ago looking at whether incumbents stay in office or get kicked out based on the performance of the stock market in the run up to the election. And certainly then the results were that if the stock market is positive leading up to the election, then incumbents more often than not tend to stay in office. And it's the opposite is true if the market is down. And just what I mentioned about positive social mood versus negative social mood. I mean, if the mood is positive, people are thinking, well, why change it? If the social mood is negative and they're driving the market down because of that negative social mood, then more often than not, they'll think it's time for a change. So, it's going to be a very interesting few months. And this year has been especially interesting in terms of elections. We've had elections for over 50% of the planet, of the voting population of the planet. So it's been a great year for democracy.
Well, my guest today has been Mr. Murray Gunn. You can learn more about Elliott Wave at elliottwave.com. You can learn more about socionomics at socionomics.net. Murray, always a pleasure to catch up with you. Thank you for joining us today. Love to have you back down the road.
Very much enjoyed it as well, Dennis. Always a pleasure to come on and look forward to the next time.
We will return after these words. You are listening to RLA Radio. I'm your host, Dennis Tubbergen. Glad you're listening in today, and thanks again to Mr. Murray Gunn of Elliott Wave International for joining us on today's program. Now, in the first segment, I started to talk a bit about stocks and how I find it quite remarkable, actually, that many people are walking around with huge stock allocations in a portfolio they intend to use for retirement income within a relatively short period of time. Stocks at this point are, in my view, extremely overvalued. And as I noted in the first segment, I am not alone in this opinion. Dr. Bob McHugh, who's a guest on last week's program, as I pointed out, wrote a piece talking about that we have the top 10 market cap stocks are dominating the stock market at a level not seen in the history of the market. And 3 stocks have almost 20% of the market cap or the valuation of the entire market: NVIDIA, Microsoft, and Apple. The point is there is not a lot of breadth in the stock market advance, and that's what Murray Gunn talked about in this past segment as well. Now, Dr. John Hussman, who is the founder of Hussman Funds, who is a widely respected market analyst, a sought-after interviewee, to get his thoughts on what the market's doing. He appeared with Adam Taggart on Thoughtful Money this past week. And I want to give you just a summary as to what Dr. Hussman sees as far as stocks are concerned. First, he sees market conditions as highly overvalued. He suggests that current valuation extremes are a lot like past market corrections and bubbles, and he suggests that the risk of a 50 to 70% decline in the S&P 500 is high. Since 2021, according to Dr. Hussman, market internals have not been favorable. He suggests that if you are in stocks, a cautious approach is warranted. And he ties this observation to broader economic indicators, particularly in the labor market. The gradual reduction in job openings, a creeping increase in the unemployment rate, and a rise in new unemployment claims are signs he watches closely, and they indicate, in his view, that the potential for a recession is rising. He also suggests that the historical increases in corporate debt, especially during periods of low interest rates, have heightened the impact of interest expense on profit margins. He highlights the trend of companies taking advantage of these lower rates to increase leverage or take on more debt, which could pose risks as interest rates rise and debt needs to be refinanced. And of course, when that debt gets refinanced, it gets refinanced at higher interest rates. He suggests that this could squeeze profit margins in the coming years as higher refinancing costs take effect. And finally, Dr. Hussman is skeptical that any Federal Reserve rate cuts in the future will be efficient, will be useful. Now, interestingly, past guest on RLA Radio here, John Rubino, in his Substack account, made 3 observations about stocks, confirming the opinions of Dr. Hussman and Dr. McHugh. Now, Rubino suggests that stock ownership, in fact, Murray Gunn alluded to this as well, stock ownership as a percentage of other financial assets hit a new record in the first quarter of 2024, rising to 41.6%. Households own more stocks now as a percentage of financial assets than at any time in the future. In fact, the current 41.6% reading is even higher than the 38.4% seen at the dot-com market peak back in 2000. That was during the tech stock bubble. Secondly, when you do an equal weight S&P 500, in other words, when you take all 500 stocks in the S&P 500 and apply an equal weighting, I should say, rather than weighting based on market cap or some other factor, an equal weight S&P 500 relative to the market has dropped to levels last seen in 2008. That was at the time of the great financial crisis. Finally, when you take U.S. stocks and you measure U.S. stocks on a price-to-book basis, U.S. stocks have never been more expensive when you compare U.S. stocks valuation to the valuation of stocks around the rest of the world. And again, we're using a price-to-book valuation here. On a percentage basis, U.S. stocks are more than 20% more expensive relative to the MSCI World Stock Index than at the peak of the stock bubble. Did you get that? On a percentage basis, U.S. stocks are more than 20% more expensive than at the peak of the tech stock bubble. If that statistic alone doesn't make you more cautious, then nothing probably will. So if you are looking to have a comfortable, stress-free retirement, if you're planning on using some of your investments to supplement your retirement income, I would urge you to think very carefully about your exposure to stocks. There are ways to hedge your exposure to stocks. There are ways to get exposure to stocks if the market goes up, but protect the downside if the market goes down. And keep in mind, just because we've seen a V-shaped recovery in the past, this does not mean that a V-shaped recovery is guaranteed. In fact, I would argue that it will likely not be a V-shaped recovery over the next correction, or after the next correction, I should say. Now, let me remind you in the time I have left that if you go to retirementlifestyleadvocates.com, there are a lot of resources available there. They're all free resources. You do need to set up a login to retirementlifestyleadvocates.com, but it is free. Just need a name and an email, and you get your login. That will get you access to my weekly Portfolio Watch newsletter, in which I'll share my thoughts with you as to what's going on in the investing markets and the economy. I'll also get you access to my weekly Headline Roundup newscast. Every Monday noon, I do a newscast sharing with you what you may not hear from other news sources as to what's going on in the investing markets and the economy. And you'll also get a copy or access to the podcast version of this radio show. Again, that's all at retirementlifestyleadvocates.com. I'd encourage you to check it out. That's all the time I have for this week. I'll be back again next week. My special guest will be Mr. Michael Oliver. You won't want to miss it. Have a great week.